From the campus of Yale University, this is Business Talk with Jim Campbell, nationally syndicated across the country on the Biz Talk Radio Network and coming to you from our flagship stations, Yale Radio WYBC and 1490 AM WGCH Greenwich. All talk and all business, 60 minutes of radio with leading figures from the world of business along with the business of politics and sports. Does Wall Street continue to put its interests ahead of its customers? Are you losing a large chunk of your investment wealth from stealth financial fees that line the pockets of your financial firms? How the financial system fails us and how to fix it. We're taking on Wall Street today on Business Talk with Jim Campbell. Stephen Davis, Senior Fellow at Harvard Law School's program on corporate governance. Before that, he headed up the Yale School of Management's Milstein Center for Corporate Governance, served on the Securities and Exchange Commission's Investment Advisory Committee and co-author of The New Capitalists, How Citizen Investors Are Reshaping the Corporate Agenda, and now just out, What They Do with Your Money, How the Financial System Fails Us, and How to Fix It, with co-authors John Lekumnik, who serves as Executive Director of the Investor Responsibility Research Center, and David Pitt Watson, co-founder, former CEO of Hermes Focus Funds, the largest responsible global group investing in mutual funds. And we're out of time, Steve. Great stuff you've done. Let's go right into it. I'm always under the impression that investors and institutional sources of money management, et cetera, have a fiduciary duty to put client interests first. Tell us how they're failing that and how they're moving our wealth to them.
Well, it's there's this free-floating anger right now, as we've heard in the presidential campaign, against Wall Street. And so one of the reasons why there is that kind of anger is because Wall Street, over the last, literally 130 years, has figured out a way to separate us, and by us I mean ordinary people that are saving money, from our capital, from our savings. And the way they do that is in part through fiduciary duty. Many of the agents that we give our money to are not covered by fiduciary duty. In other words, they don't necessarily have to act in our best interest. And what has occurred is that agents have proliferated. So when we put our money away in a mutual fund or wherever we're trying to save it, there are now as many as 16 intermediaries that have arisen between us and our money. Each of them wants to have a slice of the pie. And so if you think about at the end of a typical person's working life, have they saved enough? The answer is not. And very often you won't know that there's this loss, or rather that you should have earned a lot more than you did. And the reason is it's very hard to tell. You may see that you've gained over time. Your nest egg has grown. But what you don't see is how much it should have grown had agents not been siphoning money out of your pool.
In fact, it's a pretty scary statistic is because of the power of compound growth rate. The adding in all those sort of extra costs can take 38%, you say in the book, of the lifetime savings, even though the numbers are obviously going to be up overall, but that's more than a third that has disappeared through stealth fees.
Well, yeah, actually, it can be even higher than that. What we do in the book is to show or rather sort of compare someone's saving in the UK or in the United States, and then compare that against someone's saving in the Netherlands, where there are fewer agents, there's a different savings structure. And the typical person in the United States will, at the end of a lifetime of savings, have 50% less of a nest egg than a comparable employee in the Netherlands.
In fact, if you translate that in the work you did, it comes to $30,000 a year to live off of versus $50,000 in the Amsterdam case. It's a big difference.
That's a huge difference. It means that if you're here, again, you think that you've earned, or rather you wind up with a certain nice pool of savings, but in fact you should have earned a lot more. You should be able to count on a much more easy retirement than you wind up getting.
Now, along with that sort of transaction chain conflicts, You're pretty critical of the sort of the casino short-term nature of trading on the street now, and in London probably, and the other exchanges.
Yeah, and really the reason for that short-termism is because what we've failed to do over the last couple of decades is spend a lot of time on the governance of these agents that we give our money to. So there's been a lot of work to get corporate boards more professional and focused more on long-term performance. And boards are really much better. Corporate boards are much better today than they were, when we were, say, in high school. But we've not spent the time looking at agents. So the governance of agents is really in need of great attention. It means that there's a lot of secrecy going on. It's very hard to find out what fees, for example, you're paying if you're saving with a mutual fund.
In fact, something that I'm critical of is the high-frequency trading, often in dark pools, which is exchanges that are able to provide anonymity for the traders. So sometimes they're front-running clients even. They pay for order flow. There's all kinds of conflicts, again, under the short-term trading heading.
Yeah, that's right. And the fact is that you and I, and our listeners today, for the most part, are saving for the long term. We're saving for retirement. So we're not necessarily interested in the day-to-day performance, the short-termism of a lot of investing agents, and yet they are allowed to act in that way. So why is that? It's because we don't have the kinds of accountability and transparency that we really need when it comes to financial agents, when it comes to Wall Street.
Now, Wall Street's full of these brilliant folks, and you call it mad math, which is excessive, I think, program trading, not tied to what the business's fundamentals are. And what about the failure of their risk models and their diversification models?
Yeah, I mean, one of the things we talk about in the book is that what we've allowed is the sort of the spread of expertise, which really doesn't necessarily address the long-term needs of the ordinary saver. In fact, what it tends to do is to sort of celebrate as we said, the mad math that has occurred, and also the sort of impetus within the economics profession to look at sort of hypotheticals that really don't address real-world conditions in the economy.
Liability-driven investing, you talk about that as a risk. Talk exactly what that is, and is it risk reaching for yield is a formula, right, for taking excessive risk?
Yeah, I mean, this is if you look at the financial crisis, for example, what you find is that, yes, corporate boards took banks over the cliff when it came to high risk, but a lot of the investors their fingerprints are all over that too. They tend to go for higher risk than they ought to. And look, it's understandable at some level. The funds that we have now are under intense pressure to boost returns. I mean, again, say 50 years ago, 40 years ago, we had 16 workers for every one retiree. So that means you could have had, a chimpanzee running an investment fund or a pension fund, and you'd be fine. You didn't have to worry about it. You'd have enough money to pay out. Today, we're moving towards about 2 workers for every one retiree. Retirees are living a lot longer, so it means that there's an intense pressure. You got to fire that chimpanzee. You've got to really do everything you can to boost returns, and so there's no doubt that there are a lot of funds that go much too far in harboring high risk in the hope of getting high returns. But at the end of the day, it doesn't work.
Now we're getting down to the last minute and a half. One of the secrets is that unmanaged passive index funds outperform all these high-fee funds, and the numbers are pretty big. The passive fund, I guess, is about 0.5% of expense ratio, and highly managed, and with all that chain you talk about, is over 2%. It's a huge difference.
Yeah, no, that's right. I mean, there's the evidence shows that index funds overall do a better job in many respects. But you shouldn't just sort of pick an index fund just because it's an index fund. There are some that do a good job looking after our money, and some that do not. That's important. We got to check when you're putting your money in a fund. You got to ask some critical questions.
Okay, in our next segment, we'll look at how we could take back our money from Wall Street, how to fix some of this stuff. You're listening to Business Talk with Jim Campbell over the Biz Talk Radio Network, 350 stations around the country, and we'll be right back. We're back with corporate governance expert Stephen Davis, and we'll look into how to fix our financial system. One of the great insights I thought of this book, and you'll have to explain it in layman's terms, is that inexpensive alpha is better than expensive beta, and that's almost contrarian to normal thinking.
Yeah, I mean, look, one of the big issues here is that funds have not been aligned, and agents have not been aligned with their ordinary savers. And so they do tend to go after targets that don't necessarily make sense. And one of the big problems, just to drill down to the nitty-gritty, is the question of how much fund managers are paid and how are they paid. And a lot of times fund managers, in other words, the agents who work for the funds that we give our money to, they're paid for short-term pops in performance. So they're looking, what they tend to do is to look for investment vehicles that don't necessarily match our long-term interests. And that's so when you're investing in a fund, for example, you may want to ask, or when you're thinking about which fund to put your money into, you probably ought to ask, how are your fund managers paid? Is it for long-term performance, or is it just for short-term pops, or even worse, just for amassing more clients?
All right, I want to give you a chance now, from your top priorities, how to fix our financial system. And I know one of the issues, misaligned incentives. That's what you've been talking about. Wall Street people are not bad people; they just chase whatever the incentives are. So, give us how would you fix it?
Yeah, and I think that's very important. We're not saying, number one, that there needs to be a revolution, and we're not saying that people at Wall Street are evil people. What we're saying is that we've allowed the system to go out of alignment for years. And more importantly, what we've allowed the system to do is to miss out on the core genius of free enterprise, which is the power of ownership. That's the heart of capitalism. And what we've allowed Wall Street to do is to separate us from our money. We need to return that situation to giving people back control over their money. So one of the problems is that our regulation is out of whack. If you look at it, the regulation that addresses this question is about 42 years old, and it was developed in 1972 for an investment world that simply no longer exists. So we have to update it substantially. It used to be people were saving in traditional pension funds. Now it's mostly through 401ks, defined contributions. The regulations really need to be updated for that. What we call for in the book is something called the financial equivalent of a nutrition statement. We'd like to see regulation that gives people the information they need to figure out how much they actually are paying in fees. Right now, you can't really do that. So a nutrition statement would be a big step forward.
You call it a need for a Magna Carta. Obviously, that nutrition statement is part of it. What else is on there?
Yeah, and by the way, the Magna Carta concept, and Magna Carta itself is 800 years old now. We're saying that was for citizens. What about investors? This is the time when investors need to have protection. And one of the things we call for is a fundamental principle, which is that you shouldn't have investment without representation. And the dirty little secret in the financial markets and in pension savings is that there's very little oversight going on. Very few, either regulators or anybody else, are looking after your money and making sure that conflicts of interest are out of the way and that your interests are being served. So one of the things we call for is much more transparency. For example, when you go to your computer screen to look up, if you're lucky enough to have a 401k, you can look up typically on your screen what the transactions have been and where your stocks are. Well, you can't find out how much you're paying in fees, and you should be able to do that. And the pros can't even figure that out. There was a big fund recently in the UK. They did a deep dive, and they thought they were paying a certain amount. Turns out they were paying 4 times that amount, and they didn't even know it. So we need transparency for one thing, so that a saver can figure out what they're getting, what they're paying out, and if they don't like it, they can move their money.
Do you have thoughts on how to move away from the casino, high-frequency trading, and all that short-term stuff that ends up working against us?
Yeah, I mean, I think the big solution is if we can get the agents focused on aligning themselves with our long-term interests, then you will squeeze out those bad actors and bad approaches, because those are high risk, they are short term, and neither factor suits what most people need from their savings.
Let me ask you this now. You think that social issues, environment, climate change, etc., are good things to include in the metrics. Why do you think that over the long run that's a good thing?
Well, all you need to do is to look at, say, the BP blowout in the Gulf of Mexico. You look at the Fukushima, the tsunami that disabled and caused a meltdown at the Fukushima plant in Japan. You look at the Rana Plaza disaster, which killed 1,100 people in 2013 in Bangladesh. These are cases where companies have been cavalier when it comes to risks. And the fact is, when that happens, who suffers? It's us, the savers. And that can't, we know that that's a bad thing. We know that there are factors today around human capital and innovation that are not the sort of bricks and mortars type risks that we used to be able to account for. These are so-called intangibles. They have to be incorporated within an investment process, because if you don't, you run much higher risks than you should.
What do you mean by common sense retirement plans that share the longevity risk? What does that mean?
Well, what that means is really picking up ideas from the Netherlands. In the Netherlands, where we say that people wind up, by comparison, with as much as 50% more at the end of their working life than they do here in retirement savings, what they do there is to pool savings so that all the risks of longevity, in other words, how long people live, are shared. And you also reduce the number of agents that manage the monies that are involved. And you have a governance system for those funds that allow people, or rather the funds, to eliminate conflicts of interest and really act in the interests of those savers. Today, in the United States, if you're lucky enough to have a 401k, the fact is there's really nobody looking out for you. There's no board, for example, that represents you. You need to have your interests protected. That's what happens in the Netherlands with those kinds of pooled funds, and that's what we think a common sense fund ought to look like in the United States.
Interesting. This populism revolution that's spreading everywhere, you can tie this directly to it. Two things. Do you think that you talk about the finance industry share of GDP going from 4% to 8%, 100% increase? Is that bad? And secondly, CEO pay to workers has gone from probably under in one digit to 231 times. Is that fueling the middle class resentment? Is that something that needs to change, or the market should have the right to do this?
Well, on the first point, we've clearly seen a financialization of the economy over years. Now, that's not necessarily a bad thing. Finance is critically important to our economy. We need it to do all kinds of things, including drive prosperity and reduce poverty. It's critical. But what we need to make sure to do is to help that the efficiency gains that have occurred as the industry has grown, those gains have gone disproportionately to Wall Street itself. In other words, the data show that over 130 years, Wall Street has, even though we've got telephones, computers, ATM machines, everything that boosts efficiency, those efficiency gains have gone not to us consumers, but really to Wall Street itself. That fuels middle class resentment. And then if you look at the other issue of CEO pay, the same thing applies. We've got increasingly a sense that Wall Street operates for its own interests, and corporations do as well. It undermines what is critical to our free enterprise system, which is trust. Trust needs to be there. Without trust, an economy grinds to a halt, and the politics get real toxic, as we've seen.
That's a good way to end it. In fact, it would seem to be in Wall Street's own interest to try and fix some of this stuff so they don't have a revolution on their hands ultimately.
That's absolutely right. I mean, the question is, how do we save Wall Street from itself?
And you've been listening to Business Talk with Jim Campbell, thanks to Stephen Davis. Very interesting book, right on target, and it's called What They Do With Your Money, How the Financial System Fails Us and How to Fix It, published by Yale University Press. Thanks, Steve, for your time. Great interview.
Thanks, Jim.